The financial markets are often described as a battleground between fear and greed, a pendulum that swings violently based on macroeconomic data, geopolitical tremors, and the collective psychology of millions of traders. On a particularly volatile Tuesday, the gold market provided a masterclass in this duality. Spot gold, the world's premier safe haven asset, surged sharply higher, effectively reversing a steep sell-off that had defined the previous trading session and significantly trimming its weekly losses. This was not merely a standard corrective bounce, it was a move of historical significance. According to data analysis from Reuters, bullion positioned itself to post its largest daily rise since November 2008. To understand the gravity of this statistic, one must look back to the great financial crisis of 2008, a time of unprecedented global economic turmoil. For the current market to mirror the volatility and buying aggression of that era suggests that the underlying currents driving gold prices today are just as potent, if not more complex. The context of this price action is unique. We are analyzing a market where gold is trading in a range that would have seemed unfathomable just a few years prior, oscillating between $4,000 and $5,600 per ounce. This high valuation environment creates a scenario where every percentage move represents a massive shift in capital. When gold plunges as it did on Friday and Monday, billions of dollars in value are wiped out momentarily. Conversely, when buyers return as they did on Tuesday, it signals a profound conviction in the asset's long-term value. However, this recovery is not happening in a vacuum. It is occurring against a backdrop of shifting monetary policy in the United States, specifically revolving around Federal Reserve Chair nominations and interest rate expectations for 2026. As investors navigate these choppy waters, the primary question remains: was Tuesday's rally a dead cat bounce, a temporary recovery in a dying trend, or was it the resumption of a supercycle that will see gold breach new all-time highs? This comprehensive analysis aims to dissect the current state of the gold market. We will explore the anatomy of the recent reversal, the fundamental pillars supporting the bull market, the political and economic headwinds created by the Federal Reserve, and the technical indicators that are currently guiding the algorithms and institutional traders. By understanding these layers, investors can better position themselves in a market that offers both high risks and historic rewards. Chapter 1. The Anatomy of the Reversal. The price action witnessed on Tuesday was a classic example of market resilience. To fully appreciate the biggest daily rise since November 2008, we must first dissect the mechanics of the sell-off that preceded it and the psychology of the buyers who stepped in to arrest the decline. 1.1. The psychology of the dip. The market phenomenon witnessed this week is rooted in a core behavior of modern trading, the buy-the-dip mentality, but with a nuanced twist. The source text notes that essentially, investors who took profits on the rally to last week's historic high are now returning at more attractive prices. This speaks to the sophistication of the current participant base. In amateur markets, a sharp drop, like the one seen on Friday, often triggers panic selling, leading to a cascading crash. However, in this mature bull market, the sell-off was viewed differently. The smart money, institutional investors, hedge funds, and central banks utilized the rally to historic highs as a liquidity event, an opportunity to cash out some gains. When prices dropped, these same investors did not view the decline as a change in the asset's fundamental value. Instead, they viewed it as a discount mechanism. They realized that the asset they loved at $5,600 was suddenly available for much less, despite the underlying reasons for owning gold remaining unchanged. This psychological pivot from profit-taking to bargain hunting is what creates a floor in the market and fuels rapid reversals. 1.2. The November 2008 parallel. The comparison to November 2008 is critical for context. In late 2008, during the height of the global credit crunch, gold initially sold off. This confused many observers who assumed gold would skyrocket immediately during a crisis. However, In times of extreme stress, investors sell what they can, not necessarily what they want to, in order to raise cash. Liquidity. Once that initial liquidation panic settled in 2008, gold began a legendary ascent. The fact that Tuesday IHS rise was comparable to that era suggests we saw a similar liquidation flush, followed by a realization of value. Friday's plunge likely cleared out over-leveraged long positions, traders who borrowed money to buy gold. Once those weak hands were washed out of the market, the capital with high conviction returned with force. This suggests that the market structure, while volatile, is still fundamentally seeking higher prices. 1.3 Value hunting versus FOMO. It is important to distinguish the current buying behavior from FOMO, fear of missing out. FOMO usually occurs at the top of a market, where latecomers buy because they see prices rising. The buying witnessed on Tuesday was value hunting. The investors returning to the market are calculating the risk-to-reward ratio. At the historic highs reached last week, the risk was high, and the potential immediate reward was thinning. However, after a steep correction, the equation flipped. The bullish fundamentals are still present, which we will discuss in Chapter 2, but the entry price is now cheaper than it was a week ago. For a portfolio manager, buying an asset at $4,500 that has a high probability of returning to $5,600 is a sound strategic move. It captures the spread between the current sentiment, fear, and the long-term reality, value. This rational behavior is the primary engine behind the sharp recovery, proving that the market is not driven solely by emotion, but by cold, hard arithmetic regarding value zones. 1.4. The trap of overextension. The article mentions that investors took profits on the rally to historic highs. This highlights a universal truth of financial markets. Nothing goes up in a straight line forever. When a market becomes overextended, moving too far, too fast, away from its average price, it becomes fragile. The sell-off that occurred prior to Tuesday was a necessary release of pressure. Without such corrections, bubbles form and eventually burst with catastrophic consequences. By pulling back, the market allowed the overbought conditions to reset. Technical indicators, like the Relative Strength Index or RSI, likely moved from overbought to neutral or oversold, signaling to the algorithms that it was safe to start buying again. Therefore, Tuesday's sharp rise shouldn't be seen just as a recovery. It should be seen as a reset of the market's engine. The steep sell-off cleared the excesses, and the sharp rebound confirmed that the engine is still running and ready for the next leg of the journey, provided the fundamental drivers remain intact. The fundamental pillars of the bull market. While daily price fluctuations are often driven by technical algorithms and short-term news cycles, the long-term trajectory of gold is dictated by fundamentals. The source analysis highlights that despite the recent volatility, the key bullish fundamentals remain intact. Investors returning to the market are doing so because the three pillars supporting gold, central bank buying, geopolitical risks, and US debt issues, are stronger than ever. 2.1. The Leviathan in the room, central bank buying. One of the most significant shifts in the global financial landscape over the last few years has been the aggressive accumulation of gold by central banks. This is not merely a diversification strategy, it is a strategic decoupling from reliance on fiat currencies. In the context of this market analysis, central bank buying acts as a massive put option under the price of gold. When sovereign nations decide to increase their reserves, they do not buy in millions, they buy in tons. They are price agnostic to a certain degree. Whether gold is at 4,500 tons or 4,800 tons, their goal is national security and financial stability, not short-term profit. Why is this happening? Central banks, particularly in emerging markets, are wary of the weaponization of the US dollar. By holding gold, they hold an asset that is nobody else's liability. It has no counterparty risk. As long as this trend continues, and data suggests it is accelerating rather than slowing, there is a permanent, heavy buyer in the market. This creates a supply squeeze. When institutional investors realize that the float, the available supply of gold, is being drained by sovereign states, they feel compelled to buy the dip, knowing that scarcity will eventually drive prices higher. 2.2. The geopolitical risk premium gold has earned the moniker the fear trade for a reason. The analysis points to geopolitical risks as a primary driver. In a stable, peaceful world, investors are happy to hold risky assets like stocks or high-yield bonds. However, the world described in the current financial context is far from stable. Whether it is conflict in Eastern Europe, tensions in the Middle East, or trade wars between major economic superpowers, uncertainty is the new normal. When geopolitical tension rises, capital seeks safety. It flees from currencies that might be devalued by wartime inflation or sanctions and moves into tangible assets. Gold functions as a barometer of global anxiety. The risk premium built into the current price reflects the market's assessment that things could get worse before they get better. Every time a headline breaks regarding international conflict, the buy algorithms trigger for gold. Investors realize that while fiat currency can lose 20% of its purchasing power due to a government collapse or hyperinflation, gold retains its purchasing power. This historical track record is why, even after a sell-off, buyers return quickly. They are hedging against chaos. 2.3. The US debt spiral. Perhaps the most potent driver mentioned is US debt issues. This is the slow-burning fuse of the global economy. With the US national debt climbing to astronomical levels, the mathematics of servicing that debt becomes a central concern for the market. There are only two ways a government can deal with insurmountable debt: default, which is catastrophic and unlikely for the US, or inflate it away. Devalue the currency so the debt is paid back in cheaper dollars. The market is betting on the latter. When the US Treasury issues more debt and the Federal Reserve eventually prints money to buy that debt or keep rates suppressed, the supply of dollars increases. Basic economics dictates that when the supply of money goes up, the value of that money goes down relative to hard assets. Gold is the ultimate hard asset. It cannot be printed. Investors buying at these levels are effectively shorting the US dollar's long-term purchasing power. They see the debt trajectory and realize that regardless of short-term Fed policy, the long-term policy must be currency devaluation. This makes gold at $4,500 or even $5,000 look cheap when measured against a constantly depreciating currency. Chapter 3. The Federal Reserve and Political Headwinds. If the fundamentals described in Chapter 2 are the engine driving the car forward, the Federal Reserve's policy concerns are the strong headwinds pushing against it. The article notes that the next leg up won't be easy, primarily due to a dramatic shift in expectations regarding interest rates and the leadership of the Federal Reserve. 3.1. The pivot that wasn't 2026. Rate expectations. Just recently, the market was pricing in a Goldilocks scenario. Bullish traders were confident that the Federal Reserve would cut rates at least twice in 2026. Why do interest rates matter for gold? Gold is a non-yielding asset. It pays no dividends and no interest. When interest rates are high, e.g. 5% or 6% on a savings account or treasury bond, holding gold carries an opportunity cost. Investors lose out on that guaranteed interest income. Conversely, when rates are cut, the opportunity cost disappears and gold becomes more attractive. The expectation of cuts in 2026 was a major pillar of the bullish narrative. Traders were buying gold in anticipation of a low-rate environment where the dollar would weaken and gold would soar. This speculative buying drove much of the rally to historic highs. However, that narrative has now been challenged. 3.2. The Trump factor and the Kevin Warsh nomination politics and economics are inextricably linked. The article introduces a specific political catalyst: President Trump's nomination of Kevin Warsh for the chairman of the Federal Reserve, a position opening in May. This news struck the market like a thunderbolt. Kevin Warsh is perceived as potentially hawkish. In central banking terms, a hawk is someone who prioritizes fighting inflation over stimulating growth. A hawk prefers higher interest rates to ensure prices remain stable. For gold bulls, Warsh represents a threat. If he takes the helm in May, the easy money era of rate cuts might be off the table. Instead of cutting rates in 2026, a Warsh-led Fed might keep rates higher for longer to crush inflation. This realization caused buying to stall immediately. The longs, traders betting on the price going up, used this news as an excuse to book profits, fearing that the monetary tailwind was about to turn into a headwind. 3.3. The inflation feedback loop. PPI versus CPI compounding. The political uncertainty is hard economic data. The article mentions that prior to the Warsh nomination, traders were already on edge due to a producer price index PPI report that came in hotter than expected. To understand the market's reaction, one must understand the supply chain. The PPI measures inflation at the wholesale level, the price producers pay for raw materials. The Consumer Price Index, CPI, measures what you and I pay at the store. Historically, PPI is a leading indicator. If it costs a factory more to make a widget, high PPI, they will eventually charge the customer more for that widget, high CPI. When the PPI came in hot, traders immediately extrapolated that the next CPI report would also be hot. If inflation is rising again, the Federal Reserve cannot cut interest rates. They might even have to raise them. 3.4. The collapse of the lower rates narrative. The combination of the hot PPI report and the nomination of a hawkish Fed chair created a perfect storm for gold bears. The article states that this blew up one of the bullish narratives, lower rates, that had been supporting gold throughout 2025. Markets hate uncertainty, but they hate being wrong even more. The traders who bought gold assuming rates would fall were proven wrong by the data and the political news. This forced a repricing of the asset. The value zone for gold changes depending on the interest rate environment. In a low-rate world, gold at $5,600 makes sense. This tug-of-war between the long-term bullish fundamentals, debt, geopolitics, and the medium-term bearish headwinds, Fed policy, Warsh, inflation, is exactly what creates the violent volatility we are witnessing. The market is trying to find a balance between these opposing forces, while the fundamental drivers, geopolitics, debt, central banks, tell us what to buy. Market structure tells us when to buy. The analysis provided in the source text offers a cautionary note amidst the excitement of the Tuesday rally. Although gold traders may have found a value zone, without a support base, any price spikes are likely to fail. This insight is crucial for understanding the sustainability of the current price action. 4.1. The danger of the V-shaped recovery. The recovery witnessed on Tuesday resembles a V-shape. A sharp drop followed immediately by a sharp rise. While this looks impressive on a chart and feels good for bulls, professional technicians often view V-bottoms with skepticism. The reason is structural. A healthy market rise requires a foundation or a base. A base is formed when price trades sideways for a period, allowing shares or contracts to transfer from weak hands, impulsive, fearful traders, to strong hands, institutions with long-term horizons. The analysis suggests that investors didn't learn anything from last week's sell-off from overpriced levels. This implies that the current buying is still driven by the same speculative froth that caused the crash in the first place. If the market simply rockets back up without pausing, it is building a skyscraper on sand. Without a solid foundation of accumulated volume at lower prices, the structure remains fragile and prone to another collapse. 4.2. The case for a sideways February. The article argues that a sideways trade during February would be healthy. For the average retail investor, sideways markets, where prices fluctuate within a tight range without making new highs or lows, are boring and frustrating. However, for the health of a trend, they are vital. A sideways market during February would serve three purposes. Digestion. It allows the market to digest the recent volatility and the news regarding Kevin Walsh and the Fed. Accumulation. It gives institutional whales time to accumulate large positions without spiking the price too quickly. Normalization. It allows moving averages, like the 50-day MA, to catch up to the price, resetting the momentum indicators. If the market rushes to a new high immediately, it becomes overextended again. By trading sideways, the market builds the potential energy required for the next major breakout later in the year. 4.3. The shift to selling rallies. A critical psychological shift is predicted in the analysis. It also likely means we're going to see traders selling rallies, which is something we haven't seen in months. In a roaring bull market, like the ones seen throughout early 2025, the strategy is always buy the dip. Every drop is bought. However, when market structure is damaged by a massive sell-off, the psychology flips. Traders become nervous. Instead of buying the dip, they look to sell the rally. This means that as gold approaches resistance levels, traders who are stuck in bad positions will try to get out at break-even, and short sellers will step in, betting that the high is already in. This creates a ceiling on prices. Until the market proves it can absorb this selling pressure, the upside will be capped. This reinforces the need for the sideways trade. Mentioned above, it exhausts the sellers until there is no one left to sell, clearing the path for the next leg up. Chapter 5. Technical Analysis Deep Dive. The source text provides a wealth of specific data points that paint a vivid picture of the technical landscape. Technical analysis is the study of price action, using past data to forecast future moves. In a 5,000 pluses gold market, these levels act as the GPS for high-frequency trading algorithms. 5.1. The 50-day moving average. The trend guardian. One of the most respected indicators in the financial world is the 50-day moving average, MA. This line represents the average closing price of gold over the last 50 trading sessions. It acts as a dynamic trend line. The analysis highlights a dramatic event. The break under the 50-day moving average at 44.99. 3. And the quick recovery show me that investors respect this indicator. Here is why this is significant. The breakdown. When gold fell below 44.99.83, it technically signaled a trend break. This usually triggers automatic sell orders from computer algorithms. The bear trap. However, the price didn't stay down. It quickly recovered back above the line. In technical terms, this is called a bear trap or a look below and fail. The market lured in short sellers by breaking the support, only to reverse and trap them. Significance. The fact that the market fought so hard to reclaim the 44.99 level proves that smart money is defending this trend. As the text notes, past performance shows it closely guided the market higher throughout 2025. As long as price stays above this moving average, the medium-term trend remains bullish despite the volatility. 5.2. The swing chart and the line in the sand market trends are defined by higher highs and higher lows. According to the swing chart analysis, despite the major sell-off, the trend is up. The critical level identified is the December bottom at $4,274.02. This price point is the line in the sand. Bullish scenario. As long as gold trades above $4,274.02, the sequence of higher lows is intact. The trend is up. Bearish scenario. If gold were to close below $4,274.02, it would violate the December bottom. This would technically end the uptrend and signal a potential reversal into a bear market. Currently, the market is well above this level, confirming that the long-term structural integrity of the bull market is safe, even if the short-term action is scary. 5.3. Decoding the value zone, Fibonacci retracements. Traders use mathematical ratios, often based on the Fibonacci sequence, to predict where a correction will stop. The analysis calculates the intermediate term range as 3,886.46 to 56.02.23. This is the full length of the recent major rally. When a market corrects, it often retraces 50% to 61.8% of the move. The analysis identifies a specific retracement zone, 4744.34 to 4541.88. Over the past 3 sessions, the market found support exactly in this area. This is why the author calls it the value zone. It is the mathematical sweet spot where the asset is considered fairly valued after a rally. When price entered this zone, 47.44, 45.41, the selling pressure dried up and buyers stepped in. This validates the technical levels. It tells us that the market is not moving randomly. It is adhering strictly to technical geometry. 5.4. The short-term range and upside targets. Zooming in on the more recent action, the analysis defines the short-term range as 5602 to 3, the high, to 4402 to 38, the recent low. To understand where the price might go next on the upside, we look at the retracement of this specific drop. The target is usually the 50% mark of the drop. Upside target, 5002.31 to 5143.89. This zone is the next battlefield. The bulls want to push price through this zone to retest the highs. The bears and trapped longs looking to exit will be waiting at this zone to sell. The article explicitly states, "Looking ahead, I am watching the price action and order flow on a test of 5002 for a 1 to 5143.89. This is the pivot point for the immediate future. If gold can reclaim 51.43, the correction is likely over. If it fails at 5002 and rolls over, the sideways trade or a retest of the lows becomes the primary scenario. Strategic outlook and future targets. As we stand at the precipice of this volatile market, the path forward is not a straight line. The data, the political landscape, and the technical charts have all converged to create a complex puzzle for investors. Based on the analysis of the Tuesday reversal and the overarching trends, we can map out a strategic outlook for the coming weeks. The primary focus is now the battle for the next psychological and technical milestones. 6.1. The psychological barrier. The battle for $5,000. While the technical retracement zone begins precisely at 5002.31, the number $5,000 holds immense psychological weight. In financial markets, round numbers act as magnets. They are where human decision-making and algorithmic programming intersect. Breaking above $5,000 was a historic achievement for gold. Now, retaking and holding that level is the litmus test for the bull market's health. The analysis points to the zone of 5002.31 to 5143.89 as the next upside target. This is not just a target, it is a fortress guarded by the bears. Investors must understand that price action within this zone will be turbulent. 6.2. Reading the order. Flow. Breakout or fake out. The article specifically mentions watching the price action and order flow on a test of this zone. For the sophisticated investor, this means looking beyond the simple price chart. The bullish signal. If gold approaches 5002.31 and volume increases while the price holds steady or ticks up, it indicates aggressive accumulation. It means buyers are hitting the ask price and chewing through the sell orders. This would suggest traders are gearing up for an upside breakout, ignoring the Fed headwinds and focusing on the debt crisis fundamentals. The bearish signal, the likely scenario. Conversely, if price touches 5143.89 and immediately spikes down on high volume, it indicates rejection. This validates the theory that new sellers or shorts are coming in to stop the rally. The source text leans towards caution here, stating, "I wouldn't be surprised if sellers show up at the retracement zone because a support base hasn't been formed yet." This is the most critical strategic insight. It suggests that the current rally, while powerful, is likely a relief rally rather than the start of a new impulse leg. The market has not done the hard work of consolidation yet. 6.3. The sideways scenario, the healthy correction. If the market fails at the 5002 $143 resistance, it does not necessarily mean a crash is imminent. As outlined in Chapter 4, the ideal scenario for the long-term health of the gold market is a sideways trade during February. A failure at the resistance zone, followed by a drift back towards the $4,500, $4,700 value zone, would establish the trading range. This range-bound trading serves to kill volatility. It bores the speculators out of the market and leaves the asset in the hands of long-term holders. For the strategic investor, this failure at resistance should not be viewed as a reason to panic sell, but as a confirmation that the market is entering a building phase. It confirms that the V-shaped recovery was unsustainable and that a U-shaped base is being built. This base will eventually serve as the launchpad for a move to $6,000 and beyond later in the year. 6.4. The downside risk. Violating the December bottom. While the outlook remains bullish in the long term, risk management is paramount. The strategic line in the sand is the December bottom at $4,274.02. Every investor currently holding gold or looking to enter must mark this level. If the sellers at the 5143 resistance zone are strong enough to drive prices all the way back down and 4274 is breached, the narrative changes instantly. A break below this level would invalidate the higher-low structure. It would suggest that the market is not just correcting, but entering a cyclical bear phase. While this is currently the lower probability outcome, given the central bank buying, it is the disaster scenario that must be hedged against. Conclusion: navigating the golden horizon. The financial markets are a continuous dialogue between the past, historical data, the present, current price action, and the future, speculation and policy. The recent activity in the gold market, marked by a steep sell-off, a historic rebound, and a complex web of fundamental drivers, tells a compelling story of an asset class in transition. Tuesday's sharp reversal, the biggest since the dark days of November 2008, serves as a powerful testament to the underlying demand for gold. It proves that despite the headwinds of a potentially hawkish Federal Reserve under a future chairman Kevin Warsh, and despite the confusion surrounding inflation data, PPI versus CPI, there is a voracious appetite for safe haven assets. When the price is right, the buyers return. The fundamentals of sovereign debt crises, geopolitical instability, and central bank de-dollarization provide a floor beneath the market that is difficult to break. However, enthusiasm must be tempered with discipline. The technical analysis provides a clear warning. Markets that skyrocket without a foundation are prone to collapse. The V-shaped recovery, while exciting, lacks the structural integrity of a sustained trend. The technical levels are clear. We are currently trading in a broad intermediate range between 3,886 and 5,602. The market has found value between 45.41 and 47.44, but it faces a formidable wall of resistance between 5,002 and 5,143. For the investor, the strategy for the coming weeks is one of patience and observation. Do not chase the rally. Buying blindly as price spikes into resistance is dangerous. Watch the test. Observe how the market behaves at the 5,143 level. A rejection there is likely. Embrace the consolidation. A sideways chopping market in February is not a sign of weakness. It is the necessary pause that refreshes. Respect the trend. As long as price remains above the 50-day moving average and the December bottom of 42.74, the long-term bull market is alive and well. Gold has always